Hola, Curious Minds crew. Hope you guys have been doing well. Um, I saw a news headline this morning that was talking about employers insurance, which is a publicly traded monoline workers' comp carrier. Great company. Um, and one of the things that really was kind of shocking was that they had a Q4 2025, they posted a loss. And I know that margins have been slowly deteriorating in the workers' comp space, just as we've had more cumulative trauma claims, medical claims, just medical cost inflation, a number of different trends. And for years, we've been in a very, very profitable, very competitive workers' compensation market countrywide and especially here in California. And last September, the WCIRB here in California recommended I believe like north of an 11% rate rate increase. I think the Department of Insurance, they settled on 8.7% rate increase, and that was the first uh, rate increase in I want to say it was like 10 years or more, something like that. Don't remember exactly off the top of my head, but point is, trend was changed. So when I saw this employer's deal, I was like, whoa, I need to dig into this a little bit. So here's what I did. I went on my, as you guys know, if you've been following me at all, I love AI. I don't nearly post about it nearly as much on here on Substack, but I do try to integrate it a little bit when I'm doing research and sharing some of my thoughts with you guys. So to stay true to that, I prompted Perplexity, Gemini. I have the pro version of ChatGPT for deep research, and Claude. So I always use all four when I'm going off in a deep uh, research piece. And what you see on the screen is what Claude generated out of my prompt. And so what I'm going to show you is a couple of quick things. We're going to come back to this visualization. But here is Perplexity. So I had asked Perplexity to look at the Q4 publicly traded insurance companies, and specifically the ones that write workers' compensation. Look at the trends, look at the analysis, given the fact that employers posted a Q4 2025 loss. And then just to kind of analyze the trends. So came back with a couple of things. You can see here, and we're just going to go through this quickly, and then I'm going to jump back over to that visualization that Claude created, because I think it's just a little bit more easy on the eyes. But here's what I wanted to show you. I went across multiple deep research AI tools to try to get validation of data. So Perplexity is great because it's a real-time AI search engine. And when you look here, we're going to look at this super quick. So you can see employers, monoline workers comp, they turned in 106% combined ratio. Yeah, not good. Not good, especially when you see it compared to some of the results of their other multi-line P&C publicly traded companies. But you can see gross written premiums were down 11%. And we're going to look at a couple of things. I also pulled up a presentation that I had seen last year from WCIRB in their state of the comp market in California. We're going to look at that too. But you can see Q4 net loss driven by higher cumulative trauma frequency and broader uptick in claims. Management is tightening pricing, underwriting to restore profitability. That I think came off of their earnings call. You can see Hartford here. Hartford had a banger of a quarter. They did just hit it out of the park last quarter, doing very, very well across all of their small commercial segments. And you can see here some favorable reserve development prior year. So that's positive, right? That helps earnings. Travelers had a very strong combined ratio, favorable year reserve development. This is a common theme here. Chubb, strong growth, work comp, middle market. Also, very good combined ratio. And then Berkshire Hathaway, they ended up with, they don't have their, Perplexity didn't post their combined here, and didn't give any specific info on that. So anyway, the point is like, let's jump here. Google's Gemini also gave us some good information just to validate. Employers posted a $23.4 million loss in the quarter with 106% combined ratio. Again, underwriting loss driven by California cumulative trauma, aka CT claims. So that's just more validation. And then let's pop to deep research from ChatGPT, aka Chad, as I call it. There's a whole story behind that, which I won't get into. But you can see here that employers, this is some other good information specifically to employers. Their loss and loss adjustment expense ratio jumped to 71.3% from 59.5%. Management attributed accident year increase primarily to California CT claims frequency. So you can see there that, ChatGPT gives a little different structure. This is deep research, but it gives quite a bit of information, as you can see. That's the beauty and the power. I always like to include bibliographies in my results so that I can go straight back to the source of the data and really validate. All right, now let me jump back and we're going to wrap this thing looking at Claude's dashboard that it created for us. So hopefully you can see this okay, but it's kind of a cool visualization, right? It took the same prompt that I used to generate all that text and it creates its own interactive dashboard. So here's what we got. So Claude's showing us that market overview, maybe this is a turning point. After 10 consecutive years of underwriting profitability and declining rates, the workers' compensation market is at an inflection point, and I would agree with that. Reserve releases that mask deteriorating accident year results are shrinking, and what that means, guys, is that when there's a claim, the insurance companies have to make their best assessments based on all the information they have about where they think that claim is going to end up. So let's say they project it's going to be $1 million claim and they post a reserve for $1 million, but along the way, over the course of a year, 2 years, whatever the claims payout development period is, when they finally close that claim, or if they think that the claims that they have on the books are not going to close as high as what they've reserved, they will release some of those reserves, right? So let's say they determine it's going to be $900,000 total payout versus $1 million that they reserved. They might release $100,000. Well, when they do that, that comes right back into earnings. So that's positive. But what that's saying here is reserve releases that mask those accident year results are shrinking, right? So there's not as much padding, if you will, in the reserve release tank. California cumulative trauma claims are rising. WCIRB approved first meaningful rate increase in nearly a decade. The Q4 2025 earnings season reveals a bifurcated market, which we saw in the tables, right? Employers really standing out as the main challenged one of the publicly traded Q4 results. Large diversified carriers are posting record profits, while specialty work comp carriers are absorbing real loss pressure. So you can kind of see here where employers, their GAAP combined ratio was almost 111%. This is kind of cool. Just shows historical combined ratios over the last number of years. Now let's look and see carrier results. This is what's so cool about these tools, guys, that we have available to us now, and why I keep encouraging the member agencies that I work with to just keep leaning in little by little and learning, and it provides a really cool way to see and research and learn information. So you can see here that this kind of gives us a little bit of summary on employers. So they had, for the quarter, 156 million of total premium, down 11%. We saw that in the other table. That gap combined ratio of almost 111%, lost 23.4 million last quarter. So, on the whole, rough, especially when you compare it to a diversified multi-line company like Travelers. Um, you can see that when you write one line of business, it can be really, really great, and then it can be challenging at certain times. So anyway, so this kind of breaks down those companies, and then let's see what it gave us for California. So California work comp deep dive, and then I'll be wrapping here in like 2 minutes. You can see that this was the recommendation that the WCIRB had put out there, but that the Department of Insurance approved that 8.7% work comp rate. And California workers' comp, we don't have 2025 numbers in yet. It'll be later this year. But for 2024, the work comp combined ratio of California is 108%. So it's just, when you look at this, this gives us a little timeline, which is great. You see these kind of rate decreases, COVID hits. We've had kind of this silent deterioration, as they call it. WCIRB puts their rate in there, or Department of Insurance commissioner approves it. And then what we've started to see is some companies are firming up their rates in California. So yeah, I mean, at the end of the day, like, hopefully this this gives you a good picture of California workers' comp at a high level, based on where some of the earnings have come from the national publicly traded companies. And I just think we're going to have to just keep our eyes on workers' comp in California. Ooh, I was landing the plane here, and then I just remembered I was going to show you. Let me see. Hang on. I have it somewhere here. Yes, yes. Okay. This is from the WCIRB's State of the System Report 2025. They just held a public webinar on this last year, back in July. So I was like, man, I remember seeing something about the cumulative trauma claims trends. So I dug up this report and I got to this page. So I wanted to show you this. Again, we don't have 2025 numbers. These are 2024. But remember, employers cited that it's the cumulative trauma claims, both the severity and the frequency, that are really deteriorating their results, because something like 35 to 45% of their total premium is in California. So they're getting have an outsized impact. But look at the trends here. You can see over from 2010, we'll call it 14 years, 2010, roughly, we're not flatline, it's slow increases. But the last couple of years after COVID, it really went ballistic. And you can see here what WCIRB's commentary is here. Following the pandemic-related volatility in 2020 and 2021, CT claim rates accelerated sharply from 2022 to 2024. This marks the largest increase in recent history. And clearly, the current earnings report from employers for Q4, clearly that trend is continuing unabated and upwards. So we don't know what the real numbers are, at least I don't, for the current 2025 CT claim trends. But at least that kind of shows you and validates some of that information. So, all right, guys, I'm going to land the plane here, and hopefully that gave you some interesting information on the employer's context of their earnings call and where workers' comp kind of is based on those publicly traded company results and WCIRB stuff and all that good jazz. So no long video today, but hopefully it gave you some good information. All right, stay curious. We'll talk to you soon in the next one. Peace.